Hey everybody, Happy New Year. I am going to talk about all of the stocks I am buying in January. Before we get started, please take a minute, click subscribe, and check out the message you see on your screen. You can get the Motley Fool's top 10 stocks to buy right now. It's the best way to support this work I'm doing on YouTube. So in January, I am buying a total of five stocks. I have some extra money in my brokerage account. I recently sold my stake in Goldman Sachs. I say stake like it's a lot of money, but it was not a big investment, but it was a pretty successful one. I made a profit on it and had some extra money to redeploy. So I'm adding to four of my existing stock positions and buying one new one. So, in no particular order, here are the five stocks I'm buying this month. So, number one, and this shouldn't come as a big surprise to anyone who listens to my channel, is I'm adding some shares of SoFi, ticker symbol SOFI. They are, arguably the fastest growing U.S. bank. Definitely in their size range, they're the fastest growing U.S. bank. They have about an $8 billion market cap today, but the momentum has just been tremendous. They added 1.3 million members over the past 2 quarters alone. They're expecting to add over a million members per quarter throughout 2024. They are doing a great job of kind of becoming an all in one banking solution. And as that grows, it kind of creates a natural marketing funnel for their loan products, which is where they make their real money. So profitability is getting there. The company has not been profitable yet. They've really been in growth mode, and for good reason. They're really, they've been growing tremendously well. But they expect to report positive net income when they issue their earnings report in a couple of weeks. And they've reiterated that several times. So there's no reason to doubt that. So it's going to be a profitable bank, growing its membership base at nearly 50% annually. It has lots of room to grow still. It's a pretty small bank in the scheme of things. It's about the 80th largest bank in the US right now. And it's honestly, it does things a lot better than most other banks, especially the other online banks. Um, and last but certainly not least, I think SoFi could be a big winner of lower interest rates in 2024. Right now, their cost of capital is relatively high. They pay, I think, 4.5% or so on their savings balances. They have $15.7 billion of deposits, which is how they fund most of their lending operations. So lower interest rates would lower that cost of capital significantly. Number two, I haven't added to this one in a while, but EPR Properties is back on the radar. This is the real estate investment trust that focuses on experiential properties. Their biggest property type is movie theaters, which has also been the biggest negative factor in the stock lately. As by lately, I mean over the past few years, because the theater business obviously didn't do very well during the COVID pandemic. They also own water parks, ski resorts, a number of other types of properties that sell experiences, not products. A few reasons I'm buying, other than that very nice 7% dividend yield that's paid monthly, is the recent results have really been encouraging. The movie theater properties are performing much better than most people had expected. The AMC, or I'm sorry, the Regal bankruptcy was resolved successfully in 2023, and in my opinion, that was a very favorable deal for EPR. It freed up several of its theater properties to sell while recapturing most of the rent that it was under contract for with Regal to begin with. It could redeploy this capital, which I definitely expect it to do. EPR is the only REIT that's very focused on experiential real estate like this, and it sees a $100 billion investable universe of properties to grow with. Um, Obviously, it's not going to buy them all, but there's a lot of room to grow in the years ahead. So that's number two. Number three is Block, which I have not added to in several years, but I really think the market has given up on this company, and for no real reason. Um, Market cap is $42 billion, doesn't pay a dividend. And you probably know the most consumer facing part of the business is the Cash App, but there's also the Square small business segment, which is, the company's name used to be Square, which provides kind of payment services to small businesses all over America and in some foreign markets. The company kind of recently renewed its focus on its core businesses after a few years of, let's say, a disjointed strategy. I wasn't a big fan of the Afterpay acquisition. I was less of a fan of the title acquisition. I was even less of a fan of the change of the name to Block, with all the blockchain side projects and things like that. But the management is really renewing its focus on what it does best, which is provide payments services and financial services for businesses and individuals. Um, it looks like it's paying off. Gross profit was up 46% year over year in the most recent quarter, and there's still a lot of potential to add financial services, especially on the cash app side of the business. Um, User growth is has remained impressive in the cash app, and I don't see any reason why the stock is still down so much from its peak. I've been a big fan of this company since it first went public, and I'm adding to my position for the first time in a while. Number four, Boston Omaha Corporation. It's been a frustrating year for Boston Omaha shareholders, especially those who have larger positions, as the stock was down by about 40% in a good year for the market. This is by far the smallest stock on this list, with a sub $500 million market cap. And the best way to describe Boston Omaha is that it's an up and coming conglomerate. It is a holding company. It has a billboard advertising subsidiary called Link Media. It has an insurance subsidiary called General Indemnity. It has several broadband internet subsidiaries, which it sees as kind of its biggest growth area right now. And it also has an asset management business called Boston Omaha Asset Management. Um, so the stock's performed really poorly lately. It's kind of been a head scratcher because the business is doing quite well. All four of the segments posted solid revenue growth in the most recent quarter, and a lot of the company's investments have done really well. It owns about 20% of a company called Sky Harbor, ticker symbol SKYH. And that stock has been absolutely on fire lately. So, why that isn't more reflected in Boston Omaha's value, I'm not too sure. The business appears to be looking well. It's a very difficult business to value because management doesn't communicate exceptionally well, on purpose. They only tell investors really what they need to, and kind of just focus on long term growth. Um, and as a result, you really don't know that much about what's going on in the business. It's really tough to read between the lines, especially in the asset management business, which, in my opinion, is the biggest growth opportunity, but so far really hasn't played out the way management would have liked. They announced that they were going to try to raise third party capital to go after opportunities in built for rent housing and eventually broadband infrastructure. And while they haven't come out and specifically said this, it sounds like the fundraising in progress has not even been close to what they wanted, which not totally their fault. Rising interest rate environment makes it less attractive for potential clients to invest with them, as opposed to just taking risk-free profits from like treasuries and things like that. But I do think 2024 could be a pivotal year for Boston Omaha Asset Management. Number one, Boston Omaha has a lot of excess cash on its balance sheet that it could contribute to opportunities. It plans on investing alongside people, and that has the money to do that. And number two, interest rates are widely expected to go down in 2024. If that happens, it could create a much more attractive fundraising environment for the business. So those are the four I'm adding to. And the fifth and final one, and one that's a new position in my portfolio, is an ETF. It's the Vanguard Real Estate ETF. Ticker symbol is VNQ. Might surprise people that I don't already own this one because I'm such a real estate investor. But while I own a lot of REITs, most of them are of the smaller variety, like EPR, which I already mentioned. This is a weighted index fund, so it gives me much needed exposure to the larger players in the space. You see, there's a picture of a cell tower there. Both of the tower REITs, American Tower and Crown Castle, are among the top holdings. So this is a 4% dividend yielder. It's an index fund that's focused on REITs because it's a Vanguard product. It has a rock bottom cost structure. And a few reasons I'm buying it. For one, real estate underperformed the market by a pretty wide margin in 2023, but has a lot to gain in 2024 as rates normalize and cost of capital goes down. It's well, dividend stocks like REITs are generally very rate sensitive in terms of their share price, and I mentioned they're concentrated in the largest REITs. Companies like those two tower REITs, like Prologis, like Equinix, companies that I've wanted to own for a while, but I don't really want to pick just one. So this lets me kind of put money to work in a lot of the largest REITs in the market. Thanks for listening. I would love to hear your comments, what you think, which stocks you like, which ones you don't like, and why. Happy New Year, everybody. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.